Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Hello and welcome to the show today. We're so glad you're here as we talk about how student loans actually impact your credit score. Very interesting stuff. So let's get right to it. So for many, student loans offer kind of a pathway to pay for higher education, of course. And while using student loans to pay for college can certainly pay off in the long run, there's a huge burden with this debt, and it can feel especially heavy after you graduate. So if you have student loans, it tends to have a big impact on your overall financial health. So one way that your student loans can impact your financial future is how they actually impact your credit score. So let's explore that. Student loans can impact your credit score in a whole bunch of different ways. Student loans are a type of installment debt. So the basic premise of this type of loan is that you borrow funds to pay for your educational costs, and then in return, you're just required to repay the lender in fixed monthly payments for the duration of the loan term. You know that. But as with all loan payments, student loans can have a positive or negative impact on your score. You might actually overlook this. The deciding factor is how you manage the loan. So for some borrowers, positive management of their student loans leads to credit score growth. But for others, student loan mistakes end up hurting their credit scores. So how do these loans impact your scores? Let's take a look at some of the positive impacts. The good news is that student loans do have a positive impact on your credit score. So here are just some of the ways they can do that. Payment history is huge because payment history accounts for 35% of your FICO score, which makes it kind of the most heavily weighted factor. As a student loan borrower, you can use this to your advantage big time. When you consistently make on-time payments to your student loans, that's going to build a positive payment history. In general, this should have a positive impact on your credit score. Income-driven repayment plans. So the average monthly student loan payment is, get this, $393. Yikes. A payment of that size can take a huge chunk out of anyone's budget. So if your initial federal student loan monthly payment amount is just too high for you, income-driven repayment plans offer a reprieve. So through an income-driven repayment plan, you have an opportunity to lower your monthly payment. While this choice can stretch out your loan term, it can also help you just make your budget work. The payment amount will vary based on your income, which can make the monthly expense more palatable. If you choose to apply for an income-driven repayment plan, this won't have a negative impact on your credit score. In fact, opting for a more affordable monthly payment that you can realistically pay on time each month could end up helping your score. As long as you make the agreed-upon payments on time each month, an IDR plan shouldn't hurt your score whatsoever. Let's talk about deferred loan payments. So if you hit a financial rough patch, you might ask for a deferment. Essentially, deferring your loan payments just kind of pauses your payment obligations for a predetermined amount of time. You'll need to get approval from your lender to make your deferment, official. But if the lender grants your request, this shouldn't have a negative impact on your score either. In contrast, waiting until after you miss a payment to contact your lender, that's actually going to hurt your score. And it doesn't even matter why you're having a financial hardship. If you wait till after you miss, it will still hurt your credit score. No backseas on that one. Let's talk about Fresh Start real quick too. So the Fresh Start program offers a one-time opportunity for borrowers with federal student loans to pull their loans out of default. If you contact your lender to enroll in the Fresh Start program, the Department of Education will remove the default record from your credit report. No joke! And according to MyFICO, by the way, based on our current understanding of how the U.S. Department of Education intends for these accounts to be reported to the CRAs, we believe that many borrowers who enroll in Fresh Start are likely to experience score increases over time, resulting from the past delinquency and default information being removed from their credit files. Those consumers with little to no delinquency information in their credit file, aside from the student loans in question, likely stand to gain the most from enrolling in the Fresh Start program. In other words, taking advantage of the Fresh Start program shouldn't hurt your credit score. Instead, It's actually likely that this move will improve your credit score. All right, so now let's take a look at the negative impacts of student loans. Of course, it's also possible to hurt your score with your student loan management actions, so let's explore some of those situations. Payment history. We touched on this before, but your payment history is the most important factor in your FICO score. It accounts for 35%. But this factor is a double-edged sword because an unblemished record of on-time payments will boost your score, but missing a payment, a single payment, will likely hurt your credit score. But if possible, you can set up an automatic payment plan just to make sure you never forget to make a payment on time. Yeah, this isn't really a good solution if you don't have the funds you need to make on-time payments, so be careful. If you aren't able to make a payment, get in contact with your lender before the deadline passes. You might be able to request a deferment or switch to an income-driven plan to avoid the negative impact of missing payments. Credit mix. So student loans are a type of non-revolving debt. This lump sum style loan is just one type of debt. The other category is revolving debt. Revolving debt includes credit cards and home equity lines of credit, that type of thing. So one factor in your FICO score is the mix of your accounts, which represents 10% of your score. A balanced credit mix includes both revolving and non-revolving debt. When you pay off your student loan, it's a cause for celebration, baby. However, you might be left without any installment loans. I know it seems counterintuitive. This new lack of debt diversity could actually end up hurting your score. Now let's move on to defaulting, and then we'll wrap up for today. But defaulting on your student loan is really the worst-case scenario. Essentially, defaulting means that you aren't paying back your loans in the agreed-upon timeline. Not only will you face expensive fees, but you're going to see your credit score take a big hit. Huge hit. The bottom line? Student loans can have a big impact on your credit score. But whether the impact is positive or negative largely comes down to you. With responsible student loan management strategies like making on-time payments, your student loans can help you grow your credit score. But if you miss a payment or default on your loans, you might see your credit score plummet. As you navigate the student loan repayment process, stay on top of your loan at all times. If you have any questions about the repayment process, don't hesitate to reach out to your lender. When you do have questions, it's better to ask about the issue to avoid any potentially negative credit impacts. And if you have any questions about income-driven repayment plans and all the different options for student loan forgiveness, all kinds of cool stuff, you can find us at thecollegeinvestor.com. Also, find us pretty much everywhere you are on social media. Just search for The College Investor and you'll probably find us. We'd love to get to know you better. Thanks for stopping by today, and we'll talk to you again real soon.